You're probably paying more in taxes than some billionaires. Sounds crazy, right? But it's not just possible. It's happening right now. And the system is perfectly designed to let it happen. Let me hit you with a quick stat. According to ProPublica, the 25 richest Americans paid a true tax rate of just 3.4% between 2014 and 2018. Compare that to the average American worker who might be paying 20%, 25%, even more. So how do they do it? How do the ultra-wealthy legally pay less in taxes than someone making $60,000 a year? It all comes down to one key idea. They don't earn money the way you do. While most people trade their time for money, earning wages or a salary, the wealthy earn through assets. And here's the kicker. Income from assets is taxed differently, often more favorably than income from labor. Let's take a closer look at what that really means. When you get paid by your employer, you get taxed before the money even hits your bank account. But when the rich make money through capital gains like stocks, real estate, or private equity, they often don't pay taxes until they sell. And sometimes they don't sell at all. That's where the magic of buy, borrow, die comes in. It's one of the most powerful wealth strategies ever used, and it's 100% legal. Here's how it works. First, they buy appreciating assets, stocks, real estate, art, even businesses. As those assets grow in value, their net worth skyrockets. But here's the trick, they don't sell them. Instead, they borrow against the value of those assets. Let's say someone owns $100 million in stock. They go to the bank and borrow $10 million using the stock as collateral. No sale means no taxable event. That $10 million completely tax-free. They live off the borrowed money, sometimes for decades. No income taxes, no capital gains. And when they eventually pass away, here's the last move: die. At death, their heirs inherit the assets with what's called a step-up in basis. That means all the gains that accumulated over decades are wiped clean for tax purposes. The asset's value is reset to its current market value, and no one ever pays taxes on the growth. This strategy is so effective that some billionaires can go their entire lives without ever paying significant income tax. And they pass on that fortune nearly intact to the next generation. In the next part, we'll break down specific tools the rich use to enhance this strategy even more, like offshore trusts, family offices, and one of the most underrated legal loopholes in real estate. Don't miss it, because once you understand these tools, you'll never look at taxes the same way again. So now you know the rich don't play the same game. They don't just earn money, they engineer it. And the tax code? It's not their enemy, it's their toolbox. Let's dive into the tools that make this strategy almost bulletproof. These aren't shady tricks or back alley moves. These are real legal structures used by the ultra-wealthy family dynasties and billion-dollar corporations. First up, real estate depreciation. Imagine owning a building that increases in value every year. Meanwhile, the government lets you deduct a portion of that building's value from your taxes, as if it were losing value. That's depreciation. Here's the crazy part. You could have positive cash flow, meaning you're making money from tenants, and still show a tax loss on paper. That loss can offset other income, reducing your tax bill even further. It's one of the biggest gifts in the US tax code, and the wealthy use it to full advantage. But they don't stop there. They supercharge this with something called a 1031 exchange. Instead of selling a property and paying capital gains, they swap it for another property of equal or greater value. No tax is triggered, just a like-kind exchange. They keep doing this, rolling over gains again and again, until death. And remember what happens at death? That's right, the step-up in basis wipes the slate clean. All that tax, gone. Now let's talk about trusts. The rich don't just pass on money. They pass on control. Through trusts, they can protect assets, avoid estate taxes, and dictate how money is used for generations. One popular move? The Grantor Retained Annuity Trust, or GRAT. It lets them transfer assets with huge growth potential to heirs with little or no gift tax, all while still receiving income from the assets during their lifetime. And then there's offshore strategies. Despite what you might think, this doesn't mean hiding money illegally in Swiss bank accounts. We're talking about legal offshore trusts and corporations set up in tax-favorable jurisdictions. They're used to defer taxes, protect assets, and even optimize charitable giving. For someone with international income streams or global investments, it's a smart and strategic move. But it's not just about tax deferral. It's about control. Family offices, private companies that manage the investments of wealthy families, coordinate all of this. They handle the real estate, trusts, legal setups, tax strategies, even philanthropy. And speaking of philanthropy, don't assume giving means losing money. Wealthy individuals often donate appreciated assets to donor-advised funds, getting full tax deductions without realizing capital gains. They keep control over when and how the money is given away. By now, you're probably thinking, this is a whole different world. It is. But understanding it gives you a map of how the system really works and why the rich keep getting richer. In the final part, we'll break down how you can apply these principles at your own level. No millions required. Because the earlier you start thinking like the wealthy, the faster you can build real, lasting wealth. And I'll even show you the one loophole hiding in plain sight that most people ignore. So far, we've seen how the wealthy sidestep taxes with powerful tools like asset-based income, trust, depreciation, and tax deferral strategies. But here's the real question. Can you actually use any of this if you're not rich yet? The answer is yes. And understanding these strategies is the first step toward long-term financial freedom. Let's start simple, with how you earn your money. If all your income comes from a job, you're getting hit with the highest tax rates. But when you shift even part of your income to investments, like stocks, ETFs, or real estate, you start accessing the same tax advantages the wealthy use. For example, long-term capital gains on stocks held over a year are taxed at a lower rate than your salary. And if you use retirement accounts like a Roth IRA or solo 401k, you can grow investments tax-free or tax-deferred. These accounts are like secret weapons for compounding your wealth without giving up a chunk to the IRS every year. Now let's talk about real estate, even if you're just starting small. Buying a rental property may sound out of reach, but house hacking, using FHA loans, or partnering with others can make it accessible. Once you own a property, the tax benefits kick in. Depreciation, expense write-offs, mortgage interest deductions, and eventually 1031 exchanges to grow your portfolio tax-free. Don't overlook side businesses either. Starting an LLC or small business opens up a whole new section of the tax code. Suddenly, your laptop, home office, travel, and phone can become tax-deductible business expenses. Even if your goal isn't to build an empire, this can significantly lower your tax liability. And here's a strategy that almost nobody talks about: tax loss harvesting. If your portfolio takes a hit, don't just panic and sell. You can sell losing positions to offset your gains and reduce your taxable income. Then, buy a similar investment to maintain your market exposure without breaking the IRS wash sale rule. But here's the real takeaway. The system rewards those who understand it. It's not about cheating or bending the rules, it's about playing the game better. The wealthy aren't smarter. They're just playing with a better playbook. And now, you have access to that playbook too. You don't need millions to start. You need information, intention, and a long-term mindset. Start shifting how you think about income. Stop just working for money and start making your money work for you. So, to wrap it all up, the rich avoid taxes not because they break the law, but because they understand it better than most. They earn through assets, defer gains, use strategic borrowing, and pass on wealth in ways that minimize or eliminate taxes entirely. If you want to start building wealth and keeping more of it, the time to act is now. Learn these strategies, use them at your level, and grow from there. And if you found this video eye-opening, don't forget to like and subscribe for more content that helps you think like the wealthy. Want me to dive deeper into tax strategies for small investors or business owners? Drop a comment below. Because the sooner you start using these tools, the sooner you'll stop working for money and start building real freedom.